Hi, everyone. Welcome back to another episode of Built to Scale. Today's guest is again Layton Johns. Layton is my good friend and colleague at Brady CFO. He's one of our CFO advisors, but just love his wisdom and input. He is definitely a construction expert, a construction finance expert. And so today's topic, we are super excited to dive in on because we're going to be starting a series really dissecting Trump's big, beautiful bill that should be signed, according to what they're saying, should probably be signed by Trump by July 4th. I don't have a crystal ball, but that's what they're saying. So this is a Trump, or this is a tax bill that is barreling down at us that actually has a lot of impact for the construction industry. And we are diving in and really trying to dissect, what are the impacts here. I will say, and I want to advise everybody here, consult your personal tax advisor that what we bring up is not tax advice for you. We're simply bringing up general things to consider regarding the tax bill and how it plays out, or what are our considerations for the construction industry and how people should be framing this and viewing it for the construction industry as a whole in the United States. Even if that's not what you do as a builder, even if that's not your focus area, those industries have a lot of surrounding pieces to them that you can provide a lot of services to. So let's dive in. Appreciate y'all. I have my guest here, Layton Johns. Welcome back, Layton.
How's it going, Mason? How are you today?
Good. So obviously I say guest, but really you're my colleague, right? That you work alongside me in Brady CFO. So I need to give you a proper introduction that Layton is a good friend and colleague and one of our CFO advisors that serves our clients in Brady CFO. And today's topic, this is a very grand topic, and I'm personally excited to get into it because I think with a variety of the news that's going on, that this is one thing that I have the feeling might just like go under people's radar, and they don't even really know it, nor its impact and what it might do. We were talking over the next series of episodes, we're going to be diving into Trump's big, beautiful bill, right? Then really what we perceive are some things to consider for the construction industry. So for builders out there, what are things in this bill that could be really interesting for them? Now, I'm going to say this all over these podcast episodes. This is not tax advice. You need to consult with your own personal tax advisor, whether that be a CPA, enrolled agent, whatever the case is. You need to consult with your own tax advisor on the best strategies to implement for your individual plan, whether for your business or for your personal taxes. What we are going to be talking about is just some high level thoughts of things that we think construction business owners should be thinking about, considering what we read in this bill. And one big thing is they're talking a lot, and especially with the news lately as to what's going on, right? I think what's more on people's mind is it is our recording date right now is June 23rd. And I think what's on people's mind, and they're already seeing the news of the attacks of Iran on U.S. bases and wondering, are we about to go to war with Iran? Regardless of what's in the big, beautiful bill, I would generally say that Trump's general budget plan involves a lot of defense spending, regardless of war or not. So if you were able to get in on some defense contracts as a builder, and you are able to get in on any builds for manufacturing for defense contractors, do it. Generally, that is the thing, right? But there is a lot going on in the news. They are saying that this tax bill will likely be signed by Trump on July 4th. What a day. And the fact that it falls on a Friday and everything else, what a day. And but it will likely be signed by him on July 4th. That's a week and a half away. And so we're talking about something that could be very much so under people's radar, given the current news and everything else that's catching people's attention. And this tax bill is stuffed with a lot of stuff here, right? That there is a lot going on in here. So, we're going to do our best to dive into some of the topics as best as possible. I think, Layton, what I'm going to do, I know I've kind of been chatting the most so far. I think what I'm going to do is kind of give a general overlay of some of the things that we've caught in here. Now, this is a multi-100-page document, but what we've caught in reviewing this at a very high level, and then we're going to dive into the specifics of what each of these can actually mean. Sound good to you?
I think that's great. I think that I think we're on the precipice of a very large macroeconomic shift. Obviously, if there's any kind of, international conflict, that's going to contribute to it and, you know, polarize it that much further. But as we've seen in years past, like the last time when Trump was in office, the first tax bill that he passed was a pretty massive tax bill, and it did take a couple years for some of the things to actually kind of get sorted out. How is this going to get implemented? Like opportunity zones took a while to get established. And so, this, like you said, this is a huge bill, hundreds of pages. There's gonna be a lot to sift through, and it may take some period of time, even once it's passed, to really digest what are the actual economic impacts of this bill. But I think getting people on the discussion and, having the topic stay top of mind and not get kind of you got this red herring of what may be going on with Iran that may distract us for a little while, but staying, top of mind with your business over the next, 3 to 6 months, this is going to be a big topic.
Yeah, at a high level, like I promised that, kind of what we're seeing in here is a general theme, is that it seems like this bill is definitely focused on trying to increase or improve, the auto manufacturing industry. Ultimately, it is providing a lot of incentives to auto manufacturers, and those related to the auto manufacturing industries overall. So any providers, service providers, or product providers to those industries. Um, a lot of this does apply to general manufacturing sectors as a whole. I mean, I think there's a general theme here that trying to bring back U.S. manufacturing to some degree. I will say it does seem like there's some heavy incentives for auto manufacturers. I, you know, this bill aligns with Trump's general policies. Spending on border control, and building out further infrastructure around the border. It's going to happen, as well as deploying more people to provide border control. I you mentioned workforce, or you mentioned opportunity zones. Um, what's really interesting here as well is that there are some incentivizations against or not against, for workforce development programs, um, continued focus in the development of opportunity zones, and kind of like what we hinted at the beginning. Generally, uh, this bill apportions more money for defense spending, and um, I don't know exactly what that looks like, right? Whether it's we could actually be in some type of conflict, or it's just arming up to basically show enough force and power that we would avoid conflict. I really don't know what that answer is right now, but generally there's a lot of defense spending. And there's other things as well. One of the big items, for our audience, you know, we're careful of who to say this to, but we're originally from a high income state tax state of California, both you and I, and we both escaped that, right? But the SALT deduction limit was a big issue with Trump's original tax bill in 2017, where they applied a limit of $10,000 on local and state tax deductions on your federal tax bill. They're talking about increasing that, but there's also word that even with the increase, they may be limiting the workarounds. And there's been a lot of workarounds in a lot of states so that the states still receive a very, basically that people can still take advantage of, um, making sure that they get, the benefits of these taxes as a whole, by applying it within their businesses instead of on their pass-through or personal income taxes. But this is kind of an interesting one that, you know, in general, the federal government is trying to right size a budget. And so they're trying to implement tax incentives where they feel like there can be economic growth that would power through and create additional revenue for the federal government through that economic growth and additional tax revenues over long term. They also are trying to shore up some gaps where they would like to see additional revenue come in, and the salt deduction seems like it's one of them. So um, there's more in here, way more in here, but it seems like, for what we're talking about, this is probably, the most relevant, what we can pick out for construction business owners at a high level. So let's dive in here, Leighton. You know, the big thing is auto manufacturing. And I think there's a little nuance here of auto manufacturing versus EV auto manufacturing and EV related sales and distribution. Let's dive into this field so far. What are your takeaways about this tax bill and how it relates to auto manufacturers and anything related to that industry?
Yeah, it seems like, and obviously Elon got a little bit upset the other day, and there's a little bit of a rift that some of the EV tax credits were going to be removed or eliminated. Um, we need to remember that, part of this bill, you can't just spend money without raising money. They have to have tax revenue to cover a lot of these things. And if you're going to give somebody a tax credit for their EV purchase, that's effectively revenue that's lost that has to be made up somewhere else. And so that is effectively what they're doing. We're getting rid of a credit in order to make up revenue for some other shortfall, or we're wanting to spend in some other fashion. This really is not a spending cut bill. We are increasing our spending, and therefore we have to find ways to recoup that tax revenue. So it does seem like that is one of the mechanisms that they're going to use to do that. You mentioned the state and local tax. Hey, we're going to kind of find some balance. We're going to increase the salt deduction some, but we're also going to close the loopholes for the others that were, the bigger earners that were taking a much greater state and local tax deduction through that pass-through entity payment. So um, it is interesting because that's kind of a, EV versus auto. I think in general it seems like Trump's agenda has always been to bring back more manufacturing, bring back more jobs to the United States, and so we're going to see some additional spending from not just auto manufacturers, but all of the ancillary industries that surround it, and just industrial manufacturing in general. We're probably going to see the beginning of a new boom in that era. Deregulation is going to also contribute to that. Some of the environmental deregulation that's going to allow some of these plants to kind of get fast tracked. And so I think there's going to be an enormous opportunity for construction companies that are in the industrial construction space, or even if you're adjacent, you may want to start looking into how do we break into that space, because we may be at a point where there's an enormous opportunity ahead of us if we're prepared for it.
I think one disclaimer is, again, this bill has not been passed. So anything that we're talking about is not absolutely final. So these are things that we're looking at and that need to be considered. But there's, House and Senate versions of this bill. There's still some finalization that needs to happen. But yeah, going back to this auto manufacturing, generally, Trump is rolling back a lot of Biden's green, initiatives, the big green bill, and those initiatives, especially credits for electric vehicles, EVs. That is what created the spat, the big spat between Elon and Trump. So generally those are getting rolled back, and Trump is generally instead incentivizing additional manufacturing and production and sales of combustion engine vehicles. I mean, you and I are both from California. I know, you know, California was one of the first states to try to put in uh, some annualized goals. Goals is the wrong word. It's mandates, around how much of the vehicles in certain categories had to be electric vehicles. Like there had to be enough electric vehicles in place by certain, annual thresholds. And Trump has already fought against that, and Newsom's plan against that. And, what we're seeing here in general is, there's introduced in this bill a vehicle interest tax deduction, which
Yeah.
that has usually applied for mortgages for buying a home. To my knowledge, this hasn't been available, at least in my lifetime, for vehicles. And So they're introducing a tax deduction for vehicle interest specifically for domestic manufactured vehicles. So if you're buying something that originates outside the United States, you're not going to get this. If it's manufactured in the U.S., so if they move that plant from Mexico to the U.S. somewhere, you're going to be able to get this deduction. Um, that's is something introduced at the personal level that can affect each and any one of us. It can affect business owners that obviously get vehicles as well. Um, but yeah, I mean, this is just one of those pieces that is trying to incentivize auto manufacturing, domestic auto manufacturing one way or the other. The fact that he's taking away credits from EVs, it signals the alignment towards more combustion-based vehicles. The other things here too is he's bringing back 100% bonus depreciation, which for most of our clients, we've seen a lot of them and we've guided a lot of them to take advantage of Section 179, which nearly is the equivalent of bonus depreciation, but for new assets. Where bonus depreciation is nice is when it's a used asset that, it can be applied for new and use, while Section 179, I believe, is only for new assets. And so if you're buying a used piece of equipment or a vehicle, 2024, the bonus depreciation went down to 60. It was planned to go down to 40 in 2025, but they now are lifting it all the way back up to 100%, and they're making this retroactive for January 1st. And so if you're going to be out buying a new piece of equipment, you get 100% tax depreciation on it in the year that you buy. At least that's an option. You don't have to take that. It's an option of your depreciation method. And so from a cash flow standing, perspective, if you really need a piece of equipment, it could create incentives for you to go buy it. Now, I would generally say, Layton and I have talked on previous episodes that just because there's a tax incentive or, go buy the equipment if you really need it and still be, cost conscious about what you're buying. There's no reason that just because a tax incentive creates a short term, impact in your cash flow, that you don't have as much dollars going out immediately to the IRS because of that vehicle purchase. The reality is it will catch up over time. That you're just taking depreciation that you would have seen over a period of time and you're just front loading it. So you're getting the short term impact that if you went and bought, a 2025 Ford F-350, but only buy it if you need it, right? You still want to, make sure at the end of the day, you're accelerating a short term cash, improvement by not having money go out to the IRS. But one way or the other, with financing included for a Ford, F-250 or F-350, with finance included over the course of a 4 to 5 year period, you're probably going to spend $100,000. And the question is, do you really need $100,000 to go out the door in your business anytime soon? And so even though you can take advantage of these tax benefits, be cautious, right? That buy what you need, but just realize that, if you have a clear plan of use, that these incentives are in play for you. Any thoughts around that, Layton?
No, I think that you definitely need to measure the return on investment of any of these purchases, whether it be vehicles or equipment. But these are the tax incentives that I personally love because they really can spur on a growing company. It makes it that much easier to continue to grow. You're not effectively eliminating the tax on it, you're just deferring it in a sense. But to get to front load that depreciation while you're growing is very beneficial and can just kind of help slingshot you. But again, you do need to make, wise decisions. Am I going to be able to use this piece of equipment? Is this truck just for, glamour, or is it actually going to be put to use? And so if the answer is yes, it's going to be put to use, this may be a great opportunity to, update your fleet if you're at that point, take on new equipment that may be able to lead you into a new sector of construction. This is a very good opportunity.
Two other big things that we noticed in here that seem to generally incentivize manufacturing. There is a lot of alignment for auto manufacturing in there, but just manufacturing as a whole. So these are very novel as well, very, very novel. That there is 100% bonus depreciation on eligible structures. And I'm going to be very interested to see what the final language of structures really means, because I, and how that gets interpreted. Because if this is not clearly interpreted, this is going to be one of those things that a whole lot of people um, really try to take advantage of this, and it floods it, and then the IRS may catch up with this and really get some people in trouble of what the original intent was. But um, bonus depreciation has really applied to equipment, to vehicles, equipment, including whether you had to go buy a bulldozer, whether you had to go buy a tractor, whether you had to go um, buy any, expensive tools, all of those things applied. But in this instance, you could potentially bonus depreciate an actual facility itself. And the language does seem to be aligned for this to be manufacturing facilities. And I'm sure that they're going to include some language around what defines that manufacturing facility. But the idea being that I think the general intent is not that an office space can be 100% bonus depreciated. It has to be a manufacturing facility. But that is really, really interesting, because I think the standard term depreciation is something like 30 years right now, isn't it, Layton? That, for a facility, land can't be depreciated, but, the
Yeah.
actual facility structure itself, I believe, is 30 years. And so all of a sudden, say if you're to go buy, a $50 million facility, the idea of, from a short-term cash flow impact, that it just requires so much less capital up front in order to go purchase and to get that facility operating. And so they're trying to incentivize big auto manufacturers as well as private equity and other types of investors to ultimately get in on manufacturing, right? That's what they're trying to do, is to get money flowing into manufacturing. This is a really interesting one to me. I do hope that they for sure make sure that the language is very clear, because otherwise this could be just a big problem area of people's interpretations. But this is kind of wild to me. I have not seen anything like this in my lifetime. There's just a whole lot of new stuff in here. So yeah, this is pretty wild. What are your thoughts on this, Lane?
Yeah, it's interesting because they refer to it as qualified production property. And so we don't really know what that means. Does that include assembly? What is production? Is that fabrication? Is that manufacturing? What specifically is qualified production property? What I do find is, like you said, very fascinating about it is this will definitely spur on commercial real estate sales, commercial real estate development, specifically industrial development. We know that that's going to be impacted. That's the one of the big cruxes of this bill. And so again, this just further puts some opportunity out there to get into industrial construction. We may see that there's a shift. We have a shortfall on residential properties in this country. There's always going to be a demand for that. But we've found that, throughout the years, industry has, waxed and waned depending on what's going on in the economy. This is going to be an enormous boost to industrial production, industrial construction. And so I think that there's going to be a lot of opportunity here. I mean, you can imagine if you are in some kind of fabrication industry and say you have $1 million taxable income in a given year, you could go spend $1 million developing a piece of property and essentially wipe out that $1 million taxable income. Yeah, that's pretty amazing, and then you're at an opportunity where maybe you've just expanded your ability. You could, depending on your situation, maybe that doubled your output. It can really act as a catalyst for your business if used properly.
So this is one of the really interesting novel pieces of this that obviously is focused in the manufacturing sector. Again, I think, any business owner also wants to look at the ancillary surrounding industries to that. Like what comes to mind for me is potentially warehousing and distribution. I don't believe that they would get the tax benefit themselves, but the question becomes is, with additional U.S. production and manufacturing, that is there the opportunity that there will be more storage and distribution needed, and continue to be built out. That has been something big, since COVID, that we become, very, like, we just ordered a bunch of crap, right? We ordered a bunch of products. And so a lot of warehouse and facility, or distribution space was built out. I don't know exactly, right? I mean, are all of a sudden we going to consume more goods? Is the volume of goods going to necessarily increase based upon whether it's imported or it's manufactured in the United States? I don't. I think that's a little bit tough to tell. But if our audience can think of any ancillary benefits to, those manufacturing plants, being built and being, developed and, ultimately additional jobs being created, right? That's the idea, is that those jobs are being created in a particular area. And so, things that come to mind, for me is, uh, additional jobs is going to involve additional housing. It's going to involve additional services and food and restaurants and various retail centers around these manufacturing sites. And so, if you can align yourself, that your specialty as a builder may not necessarily be building manufacturing plants, but say you're really good at retail, that you can put up, new little fast food, shops and various little strip malls, or you're great at residential housing and you're able to figure out where they're going to be building some of these plants or investing in them and where the jobs are going to be coming, those could be still economic hotspots where could be great for you to have some additional new jobs. And so, things to consider. I think the last topic, at least for today, Layton, that I want to dive into with you, because there are multiple topics here that we're going to dive into. A lot of this has to do with manufacturing, but another one here, and again, this kind of aligns with what I was saying about the fact that additional jobs are going to spur additional spending out around surrounding that manufacturing facility. They're introducing no tax on overtime. Um, and, so you're talking about, people have had difficulty being incentivized to go work in a manufacturing plant. All of a sudden, they could potentially make more and take home more as a result of having no income tax on overtime. And then those additional dollars are going to be spent in their local community, buying food, buying services, buying goods in their local community, and that spending. And so I think what's really going to happen here, as we're kind of verbalizing this, is that some of these more blue collar kind of, there is actually the term opportunity zone in the tax code, but like it's Trump seems to be really incentivizing these little opportunity zones where it's kind of, these blue collar areas that, where manufacturing is going to exist, where there's lots of land, that generally there's going to be economic booms in these areas, that it may not necessarily be in a big city itself, but rather in the more rural areas where some of these plants are going to be built. This is really interesting, the idea of no tax on overtime, that it's really trying to bring people back into, manufacturing activities. It's trying to incentivize. And the overtime applies not just to manufacturing. When I've read it, that there is no application just to manufacturing. So we're talking about if you're working at a service industry job, if you're in the trades, right? So for, and this is actually, I think, kind of has a double effect for construction business owners, that this can help them attract additional talent, because if they're paying overtime to any of their labor, that labor is going to have more to take home. That they are going to be more incentivized to work on your job. So this is really interesting and neat. What are your thoughts on this no tax on overtime?
I do think that one thing Trump has been consistent on is that he seems to be for the blue collar worker. He's always kind of promoted that, that's the American that he's out there to try to lift up. And it does definitely seem like that's the case, with the no tax on overtime, potentially no tax on tips. I know another aspect of this is that they individuals may be able to apply funds in their 529 plan to trade school going forward. So it does really seem like he is trying to promote these blue collar jobs, plumbers, manufacturing, and I think that that's gonna it's gonna create a new economic boom in those areas. I think that those are jobs that historically have been, parents kind of encouraged their kids to go to school so they didn't have to work those jobs. I think we're seeing a shift where those jobs are now being glamorized. It's interesting to kind of see the effect of what AI has had on some of the white collar jobs, that we may see a new era of manufacturing and blue collar hands-on work in America in the coming years. And so I think this tax bill is going to help push for that. And you made an interesting comment on that if we do see these factories get built in these communities, you're absolutely right. Especially if there's an influx of individuals to work at those factories, you are going to see new restaurants, you are going to see new housing. But some big things that I know a couple of my clients are very excited about, where they're either in public works or healthcare construction. Hospitals are going to have to expand. Schools are going to have to expand. We've kind of seen that in some of these communities where they had a large influx of migrants come in. They just couldn't handle it. It was too many too fast. You will see further government spending, whether it's at the state level or the federal level, to incentivize building out the infrastructure of these communities. Wastewater treatment plants, water filtration centers, all kinds of things. And so if this bill works, it's going to be a huge boom for construction. In the short term, the last couple of years, we've been dealing a lot with interest rates, an election, some uncertainty. I think that there's a real opportunity over the next couple of years that, we're going to get into this new kind of golden age of construction, I would say.
I think it's just to what we talked about that um I think it's going to be in the zones where it applies, right? That I don't think cities are necessarily going to stop growing. I mean, they're still an economic hub, but um generally you go build a new manufacturing plant where the land is cheap and you're going to build it in a rural area because you're going to need resources and land and everything else. So this is going to incentivize a lot of building in probably more rural areas. And that's our opinion, right? Are we absolute crystal ball experts here? No, but given what we're analyzing here, this seems to be the general intent. I mean, and if you think about it, that's Trump's voter base, right? I mean, that he is making, he's made promises to his voter base and he's trying to keep his voter base happy. And that is his voter base. And so I think if builders are already in those areas, as well, or if you're a builder in a metropolitan area and you could potentially do jobs in these areas, all the better for you. But yeah, I think in general, um, this bill seems to have a lot of language written for U.S. manufacturing, especially auto manufacturing, but there's a lot of ancillary effects to this, right? That by building out those plants, that it's going to have some ancillary effects that communities and towns have to be built around that. And that so you know if you're not necessarily an expert in building out manufacturing plants, that isn't to say that there's still opportunity abounding here. You just need to align yourself and understand where these opportunities exist. And so yeah, it seems like this is the plan. So I Layton, I really do. There's so much to dive in here that we're going to have some additional episodes and additional recordings on some of the additional items here that like you said, I want to dive in further a little bit on the workforce and and the incentives for workforce development programs and how it applies to construction workers. Again, tie that back further to overtime. What's in the plan for spending at the border, as well as dive into really opportunity zones a bit more, defense spending, as well as that SALT deduction and what it really means. Again, if we want to understand what to do, we need to look at Trump's voter base and where his votes came from, and he is going to make happy where his votes came from. And some of these things, generally all of these things align with that one way or the other. And so I want to dive in further into that with you, but we've dived in pretty well here today. I really appreciate you, Layton, that we could dive in right now. Yeah, any final takeaways for our audience?
I think this has been good. I think that we are going to get through this period of speculation of what's going to be in this bill. We'll get to really assess it once it's been passed. I do think it's definitely going to take some time to sort out, but the more conversations that we have around it, the better we're going to understand it and be able to advise clients on how to take advantage of it. I do think that, a big key thing that I've been advising clients is be prepared. Don't spend a bunch of money. Don't go take on a bunch of debt right now. We're kind of in a little bit of a holding pattern. There's going to be an opportunity that comes. And for those that are patient and don't overextend themselves in the short period, we're going to be able to take advantage of a great opportunity that's on the horizon.
It doesn't stop some of the fundamentals, right? That you need to keep rolling. Um, and some of these things regarding this tax bill, some of these incentives are definitely more like you could see rapid fire effects of them. But other things are going to take some time to fully see the effects, like, you know, um, people invest in manufacturing plants, there could be some more immediate effects to this, especially if, the 100% bonus depreciation for the eligible structures come into play. But what we've talked about building out, communities around that, that's going to take some time, right? That there's going to have to be some time play there. And so I think right now, like you said, fundamentals, right? That, keep putting out estimates, keep putting out bids, making sure that you have a good flow of work, that you have good backlog, that you're not overspending, that you're watching your P's and your Q's. That's just really important right now so that, as we learn more, you can take advantage of these opportunities once we really see that, okay, this is definitely trending this direction and I need to go get in on this. Yeah, thank you, Layton. I appreciate you that we could dive into this so much that, again, we'll be, diving into this further. There's so much here in this bill and there's probably gonna be updates, but I just think that there's a lot of exciting stuff in here. And like we mentioned that, this is kind of flying under the radar, sadly, that, with all the other economic news and there could be reasons for that too, right?
Yeah.
And with all the other things going on in the world, that it feels like this is going to kind of fly under the radar and just get signed pretty quickly here. Knock on wood. So yeah, we'll see. But excited to continue to explore this with you, brother.
No, I agree. Something that I'd like to challenge us is, once this gets passed and we can really digest it, I would love to develop some real world narratives of here's a real example of how somebody could take advantage of this tax credit or really take advantage of this deduction. Or, there's also some stuff about the R&D credits that you may just be able to start deducting that. And so there's a lot of things to really work through. Giving some real life, real world scenarios of how people can take advantage of it, I think would be really neat.
Yep, absolutely, brother. So thank you for coming on. Thank you for joining me today.
Yep. Thanks, Mason.
Awesome. Hi, everyone. So if you enjoyed today's episode and you found value, or it raised some questions for you about the next best steps for managing your finances in your construction business, please reach out to us at bradycfo.com. There's a contact page there where you can fill out, and that will come straight over to us. Either that, or you can personally find me on LinkedIn. My name is Mason Brady, and feel free to send me a message, and happy to chat and talk through anything you're facing today, and happy to provide some advice. So thank you all. Appreciate it.